I'm here with Dom, who just got back from a trip to New York, where he got an opportunity to meet with a few different companies. Dom, tell us a little bit about it.
Yeah, I went to the Three-Part Ideas Conference last week and met with several different management teams, got to listen to presentations on companies, and there were a couple that I knew going in that I thought would be most interesting in terms of an investment and just the business in general, and figured we would chat about those three today.
Absolutely. So I saw your report. I think it makes sense to start with the Seaport Entertainment Group, since that's a portfolio company of ours. You got a chance to meet with some members of the team there, the CEO, CFO, and also SVP. What were your takeaways from being in the room with them?
Yeah. So Matt Partridge, he's the CEO. He's been the CEO for, I'm going to say several months now. The prior CEO left to go take a different job. And basically Matt and the team has done an incredible job. When they took over this company, which was spun off from the Howard Hughes company, this is just a hodgepodge of assets. They have a AAA baseball team in Vegas. They own the ballpark, and then they own air rights above the Fashion Show Mall in Vegas. And then they own several different buildings in the Seaport District in New York. And basically, long story short, like the management team has done a phenomenal job of leasing up many different buildings. They're on a path today where they've essentially taken a lot of the downside risk of the business and stock off the table. There was a building called the Tin Building that hemorrhaged money. They shut that down. They're now planning to lease that to a venue called the Balloon Museum. They have a corporate event space, and then there's an immersive art experience called Meow Wolf that's set to go in, I believe, in 2027. And so we're now going from a real estate company that had several different vacant units. They have a lot of tenants incoming, and just the overall, I'm going to say, vibe and productivity of all these units. A lot of them are restaurants or entertainment spots. Seems to be on the rise. And so far, like my takeaway was management team has just done a great job, and they continue to see several different opportunities and are just doing things that are a little more creative than what the previous owners did.
Phenomenal. Yeah, and you spent some time down in the area too during the finals also. What was it like?
Yeah, New York was buzzing. I ended up having to wake back up because it was so loud during the Knicks game that I knew I was missing something. So turned it back on to watch that come back. And then I went down to the Seaport District after the conference and got dinner at one of their newer concepts. It's called Sadie's. Just a nicer restaurant, and then they also have an outdoor spot as well that's basically like a bar. And then they set up a TV, just a large screen TV basically, and they had the World Cup on it. They had a private event. It was like the Brazil game, so they had a private event where somebody that wanted to watch the Brazil game rented out the event space. So all in all, there is just always something going on in New York, in Vegas, that there is always going to be incremental visitors or new visitors coming to New York, the Seaport District, that they are just trying to slowly but surely just gain more foot traffic. And their leases are structured such that there's a fixed base rent, and then they have like a variable rent component that's tied to the performance of these restaurants and venues. And so the more foot traffic, the more sales these restaurants do, the better the company does overall, generates more rental income. And then you can imagine as leases come up for renewal, you now have more historical context of how well just several different spaces have done. So it gives them a little more bargaining power when leases come up for renewal to push the rent a little higher than maybe what they could charge when space was more vacant.
Absolutely. Yeah, it sounds like a growing area down there. My understanding from reading your report too is that they're planning to exit some rent-controlled units, and that'll actually result in some savings from interest expense. Tell me about that.
Yeah, so they have a significant amount of cash on the balance sheet today, but they have, I believe it's 10 million of preferred stock that has an interest rate of either 14 or 15%. And that came from part of the spinoff, I believe. And there's a certain clause in the preferred stock where they are unable to repay it, I believe, prior to 2029 unless certain conditions were met. And I'm pretty sure the two conditions were 250 Water Street has to get sold, and then these rent-controlled apartments that they own would have to not be owned by Seaport. And so they've already sold 250 Water Street that closed earlier this year, and now they have these 21 units. Not all of them are rent-controlled. I think half of them are, and basically that apartment unit does nothing in terms of revenue earnings because of the rent stabilized nature of basically like half the units. So the thought is, like, even if they sold it for $0 today, but could pay off the 10 million of preferred, you're saving 1.4 million of interest expense on a yearly basis. They're not going to sell it for zero. They're going to sell it for something. If they somehow manage to sell it for $10 million, it's an immediate $1.4 million savings, and at basically no cost to the company. So they are marketing the property, but nothing is official yet.
Interesting. Sounds like a great opportunity to talk with the team over there, and the thesis is playing out. So that's phenomenal to hear.
Yeah.
And
yeah, they continue to do things they call them activations, just different events that drive traffic to the area. They own a building called Pier 17. During like the US Open, they have what they call an activation where they basically set up tennis courts. Pros may come and play with just different people on top of the building, take pictures. So they're really focusing on driving like social media engagement and just try and drive traffic any way possible in a cost-efficient manner to the Seaport District. The one event space that they have in the Pier 17 is like, I believe it's 40,000 square feet that is just going to be for like corporate events. And their goal is if they could have some sort of conference, basically like maybe the one I went to, they could have a conference at that event space, and then they could have like a happy hour after the dinner or after the event in the Seaport District. And then after the happy hour, you could potentially have dinner in the Seaport District. So you could have a scenario where somebody is in the corporate event space at some local restaurant for a happy hour and then goes to dinner all within a 30-second walk of each other. And that just, again, is all traffic that is not there today that they are trying to get there.
I like that plan. Yeah, taking advantage of the travelers and also local people who live there. I mean, travel is so driven by social media too. So, that's certainly a good play to start doing that.
Yeah, agreed.
So there's two other companies that I wanted to talk about too. The first being ATN International. Can you tell us a little bit about that company?
Yeah, so ATN, think of them as either a broadband company, so they have fiber connectivity to homes, and then they also have in their international business a mobility business. Just think of like a cell phone plan. On the U.S. side, they only have the broadband, the fiber business, and they still have some legacy copper business. They're focused in like Nevada, Arizona, I believe Utah, that general region. And then they also have in one of their their main portion of their business is up in Alaska. And Alaska is interesting because it's such a remote, challenging environment to work in due to the climate conditions there, that it's basically them and another company called GCI Liberty that's up there. GCI Liberty has 95% plus market share up there. And management's focus on that side is to drive market share gains through laying new fiber up in Alaska. Then they've got the international business side, which is a combination of the fiber business, and they have like a cell phone plan business. The cell phone plan business right now is if you remember like 20 years ago, you may go to a Walgreens and buy like a prepaid phone that gets you an hour or 2 hours of minutes and maybe like 1,000 text messages, something like that. You might be too young to ever remember that. And then today you obviously have like the monthly subscription plan. Right now, a lot of their revenue is derived via the old prepaid cell phone plan. They're trying to convert people to this new monthly subscription bill. In combination with that, if you can sign people up for this monthly subscription bill, the monthly phone plan, plus have them on your fiber, your broadband, basically home Wi-Fi subscription, if you can get somebody on both of those plans, it reduces the churn, so people are less likely to move off of a fiber and a cell phone plan that are like bundled together than if they were just on two separate fiber and cell phone plans. So their goal is to start, it's called convergence, trying to converge people from one of the plans to both of the plans. Reduces churn, should reduce sales and marketing expenses, and overall drive higher margins. So they've got two sort of distinct business models that the CEO, Naji, just took over 8-9 weeks ago at this point, and he sounded enthusiastic and optimistic that there is some low-hanging fruit that they have the opportunity to take advantage of.
Yeah, I like where his head's at. You got to think, if you buy a prepaid phone with 1,000 minutes, at the end of that term, you're going to have to buy a new phone, and
Right.
You're going to be evaluating at that time, is this, what phone's the best option versus if you just get in a recurring plan, you would have to be consciously thinking about this. So
Exactly. Yep.
yeah, I think that's a great thought. It was interesting to me that they have two different businesses as well, with the international and then also the US. And it seems like they also, or it sounded like from your report that they just had a government subsidy or something along those lines. Can you tell us about that?
Yeah, so they just got I believe it's a $150 million grant program through called the BEAD. Called a BEAD contract, and it's specifically for Alaska, and it's meant to basically subsidize the build out of fiber in rural areas of the U.S. So if you're living in Alaska and you live off the beaten trail, the only way, sometimes you can potentially have GCI Liberty have copper out there, which would have been laid decades ago. You could have Starlink today, or there's this BEAD program that is subsidizing the build out of fiber. And so ATNI is getting $150 million, and the goal of that is they're going to connect basically like Anchorage, Alaska to some other major city with fiber. And so they're going to be able to, instead of fiber costing them maybe $300 million, and the ROI would not make sense to lay it based on how many customers they think they could get, this $150 million grant allows them to reduce their total CapEx spending that the company has to lay out, and therefore improve the unit economics of the fiber build out. Alongside that, there's nothing that precludes them from branching out that one main large cable or one large fiber line.
Right.
So they can branch out to neighboring, maybe smaller towns that, again, either have Starlink or copper, but could now potentially have fiber, because instead of having to, again, build out that long fiber line and then branch off and pay for everything, they now only have to pay a portion of that long build out, and then they're on the hook for that offshoot of fiber. But again, when you're not paying for that main build out, the economics change of where it makes sense to connect homes and businesses. So the BEAD program, from what they made it sound like, is a game changer. GCI Liberty, who again is their main competitor, is basically all copper at this point, and it's like a legacy technology. If you had to choose between a copper or fiber, you're taking fiber every day of the week, assuming the price is not materially different. And I suspect ATNI is going to price their fiber monthly subscriptions like very competitively relative to what GCI would charge for their copper business.
That's a huge opportunity. I mean, after you focus that one giant build out, there's so much potential to go back and pick up other neighborhoods and areas, like you were saying. So,
Exactly.
You get the big grant, but then there's also some other ancillary benefits that will come later in the future. So
Exactly. Yep.
that's great. Any other takeaways on ATN?
The other main thing is they spent over the past couple of years a significant amount of money to build out fiber in their U.S. business, and their U.S. business is like the Cayman Islands, Bermuda, just like different like islands, I believe. And they spent a lot of money on CapEx building out those different regions, and thus far the results are nothing spectacular. And the way ATN is structured is their debt profiles are remote to each subsidiary. So like the US business has, I'm just gonna say roughly 700 million of debt, and I believe the international business may have 100 million of debt, and then there's some other corporate debt as well. The US business that has the majority of the debt is what you would consider like, if you were to say like a good co, bad co, you would say like the US business is the bad co, and it has all the debt. And the US business may generate a couple million of operating income, and that's hopefully today lower than what like a normalized rate is. Again, they just had the CapEx build out. Management's goal is now to generate revenue that doesn't cost anything because the CapEx has already been spent. So if management is correct and they can generate more revenue, if they can turn on more subscribers to the fiber they just laid, that's great. You now have potentially two good businesses. If the US business does not improve, and like today's business performance is more indicative of what a normalized environment is for them, the best thing they could do is, if the US business is only generating anywhere from 5 to 10 million of operating income, has 700 million of debt, and it's remote, cannot go after the international business, which is the good business, you would just say, okay, like the US business is not economical to operate, and just basically throw the keys, tell the debt holders to take the business. And then you'd be left with an international business that might generate, I think, somewhere around like 60 million or so of operating income, has almost no debt, and they recently sold their tower business, which is going to generate about 300 million of cash. They have to pay taxes on that, but they'll use that to pay off some of the corporate debt. And if you stripped off today the US business, you'd be left with a net cash balance sheet in an international business that's generating $60 million of like operating income, and the market cap or enterprise value would be somewhere around like $400 million today. So you could buy technically like ATN today for, call it 6-ish times operating income, which the international business is a growing business and has other opportunities. It would be like a no-brainer. But the question is just what happens to that US business? Does it improve? Does management take basically like the good cash flow from the international business to fund maybe other projects at the US business? That's like the main risk, but there's a lot of optionality at the business.
It's a fascinating one to keep an eye on. And lastly, there was one I was really interested in as well, Sky Harbor, which my understanding is that they lease hangar space to private airlines. Can you tell us a little bit more about that?
Yeah, I followed them for a little while now, and all you have to do is like look at our client base. Like the world, the US is just getting richer and richer every day, and one of the pinnacles, I guess, of wealth is being able to fly private. And if you can fly private, you are probably going to fly private. And so that just means there's going to be more demand for private aviation due to the increase in wealth that we've seen. The bad part, so you've got increasing demand on the private aviation side. The issue is on the supply side, not of planes, but of where do you store the planes. And I don't think the US has built a new airport since, I think it's like might be like 1980 or something, might be Denver. I don't remember exactly what it is, but basically the number of airports is not increasing. The size of the airports they're basically landlocked. You can't really expand an airport. And that means that you cannot create more hangar space really than what is already present. So Sky Harbor's thesis is, hey, let's go into airports and buy land or hangar space that is available, and we will build out potentially a new hangar. They now have an in-house construction team to build and design the hangars. They go in, build the hangars, and then they lease them out to just private aviation, either companies or individuals. And the business model is like relatively straightforward. They've got several different new hangars that are currently in lease up and construction. And it's just like one of the easiest ways if you want to play just like the growing wealth in the US, like it just like such an easy, straightforward business to understand.
Can you talk to us about the pricing model that they have versus your traditional competitor in the business?
Yeah, so they only lease out the hangar space. It might be for like one region, it's $50 per square foot, versus there's something called an FBO that generates their revenue more on a spread between like the jet fuel, gasoline prices. So like if jet fuel costs these FBOs $4 to bring in, they'll charge the private jet owners $4.25, and that like 25-cent spread is how they generate their revenue. So that differs from Sky Harbor, who only generates their revenue through the leasing, and maybe some like maintenance, but primarily through the leasing of the hangar space.
Yeah, it's an interesting change. So I thought that was good. There was also another thing that caught my eye when looking at your report. The company is relatively top heavy in the ownership. It looks like it's a smaller group of owners who own, I think it was roughly 40%.
Yeah.
What are your thoughts on that when looking at that business?
Yeah, I think a couple of them are either founders or owners of or operators of the business. I would say historically, when we see higher insider ownership, we'd like to think about the incentive alignment that is with us as minority shareholders. So if the company was larger and we could take like a meaningful stake in it, whether we would or would not, I haven't decided. But where the market cap is today, it's probably too small. But historically, we would see when we see higher insider ownership and an alignment of incentives, we typically think that that is a good thing.
Great. Well, anything else you want to add to Sky Harbor?
No.
Great. Well, thanks for your time today. Anyone who is not subscribed to the Substack, it'll be in the comments. But yeah, thanks for watching.
You got it. Thanks, Howard.
Yep. See you, Dom.